Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, we hope you had a fantastic Thanksgiving and, spend some time with friends and family and relaxed a bit as we continue to deal with a very challenging financial marketplace. I don't have to tell you, you have experienced it. If you're trying to get a loan, rates have gone up. If you are investing in the financial markets, which most of you do through 401ks and various types of investment accounts, you are likely feeling some level of pain, especially year to date. But the good news is the markets actually responded, the equity markets, that is, quite nicely most recently, because this time of year in November, December, usually we get an upward trending market. Let's hope that continues entering into the new year. But today's topic is why women are better investors. Now, a Fidelity study that I'm going to share a little bit of the findings today was very revealing, and there's some characteristics of why women, again, based on this Fidelity study, tend to be better investors than men. So let's jump in. And what's interesting is, some of these factors, after you think through them, excuse me, may make total sense as we jump in. So why women are better investors. So some of the common women stereotypes are women need to be persuaded into understanding finance. There's also some level of belief that women are risk averse spendthrifts and who need to be discouraged from excessive shopping. And even sometimes financial advisors assume their female clients want less control over their investments, which is not the case. But research doesn't actually bear some of these stereotypes out. The Fidelity study I mentioned earlier noted that women investors consistently outperform men by almost a half a percentage point each year. And over the long term, of course, this could lead them with hundreds of thousands of dollars more in retirement. Now, you may be thinking, well, okay, it's interesting that women outperform men, and it's also interesting that they outperform them by an average of around a half a percent per year. So that's not really a big amount, or at least on a percentage basis, that's not a big amount. But compounded over a longer period of time, that actually can add up. And I'm going to go into what the calculation looks like. Let's assume, for example, that the average rate of return over a 15-year period, starting with a starting balance of $1 million, and then the second option, or let's call it route two, is the same $1 million with that extra half a percent per year, again, over the same 15-year period. How much more money would one have if they earned just on average a half a percent per year, investing $1 million over a 15-year period? You could see just by that additional half a percent compounded every year, they would end up with about $150,000 more over a 15-year period. Now, of course, this does not take effect things like taxes and inflation. This is just simple math, comparing a 5% rate of return compounding over a 15-year period of time, and a 5.5% rate of return compounding over a 15-year period of time. The difference over a long term may surprise you, but that's the power of compounding interest. So again, based on this Fidelity study, women earn on average around a half a percent more per year than men. Congratulations, ladies. You are being acknowledged by Fidelity's research in the financial world. Let's jump into some of the reasons why. The studies show that women spend more time researching their investment choices, which prevents them from taking, quote, hot stock tips and trading on whims that tend to be characteristics of men's behaviors. And of course, that would weaken men's portfolios as well. And women are more likely to take on appropriate levels of risk with their investments than men. And interestingly, both of the findings, of course, make for better investing outcomes. And women tend to have a more consistent age-based allocation where they receive proper diversification to help protect their money with down markets, regardless, of course, if the markets are up or down, but it's particularly with down markets. And women tend to stay calmer in down markets. Now, of course, the markets have been challenging. You all know that, as I noted earlier. Women, at least theoretically, according to this study, would probably be more calm in down markets, maybe not react as emotionally to a negative financial headlines or negative news. Per the study, women also stay consistent on, as it's noted here, age-based asset allocation. And really what that means is, depending on what your age and what your risk tolerance is, developing a portfolio to adjust for that. For example, if you're younger, you're likely going to have more stocks than bonds, just to give you some high level examples. If you're older, you probably will have more bonds than stocks, because theoretically the bond market is less risky and could hedge against downward equity market. Of course, the bond market is not doing well this year to date, primarily because rates have been going up. So women, keep doing what you're doing. The Fidelity study acknowledges you again, and if the trend continues with this 0.5% per year, you could see the math pretty clearly will show that women will win again if they continue to do these things over a longer period of time than men. So congratulations, ladies, and you keep doing what you're doing. To that end, if you would like a second opinion on your portfolio or financial situation, you can go on our website. This is what the front of our website looks like, nicholswealth.com. You can click on the upper right-hand tab. That's the Contact Us tab. Fill out the information, and one of our advisors will reach out to you and answer your questions and hopefully give you some clarity and some confidence in today's financially challenging environment. Thanks again for watching. Bye-bye.